This week we're looking at the follow-on from last week's lecture, which was on general deductions. You will recall that there are two positive limbs in terms of general deductions. The first positive limb is that the loss or outgoing is incurred in gaining or producing your assessable income. The second positive limb is that the loss or outgoing results in a necessary incurring of in the carrying on of a business for the purpose of gaining or producing your assessable outcome. There's the note that mentions Division 35, and then there are the four negative limbs in subsection 2 of section 8-1, the first being a loss or outgoing of capital or something of a capital nature. The second being a loss or outgoing of a private or domestic nature. The third is that the loss or outgoing is incurred in gaining or producing exempt income. And the fourth is a provision of this Act prevents you from deducting it. Now that becomes relevant because effectively that's a specific non-deduction provision, and tonight we're talking about specific deductions. Section 8-5 refers to specific deductions. You can also deduct from your assessable income an amount that a provision of this Act allows you to deduct. So it's very much the partner provision, if you call it, with subsection 2, paragraph D. And that takes us very efficiently, as the PowerPoint slides do, to divisions 25 and 26 of the Act. Division 25 is the amounts you can deduct. And what the slides do is they just touchstone, not all of these sections, but some of these sections. The first one that's looked at is tax-related expenses, 25-5. So here you're thinking about bookkeepers, accountants, BAS agents, lawyers if they're providing you with tax-related advice. All of those types of losses or outgoings are allowable deductions. The next one is repairs. And there are a couple here that are often the subject of questions in tutorials and exams. One is repairs and the other is 25-45, but let's stay on repairs. The key thing with the repair is the item that, whatever it is that's being repaired, must need to be repaired. You can't improve the item. If you improve it, it's not a repair. If you improve it, it's a capital expense. Think about a wall, for example. If anything's changed, if something is a patch and paint, if you like, because there's been a hole in a wall, that's a repair. But if you change the fabric of the wall, what I mean by that is if it's plasterboard currently and you turn it into brick or concrete or render, then that's not a repair. You can't replace the entire item and it won't therefore be a repair. Lease document expenses, so you pay your lawyer to assist you with the lease document for premises. Borrowing expenses, the interest component. Bad debts. Now remember, if it's to be a bad debt, you would need to be an accruals-based taxpayer, and you've already included the amount in your assessable income, and you're thereby claiming the bad debt, the allowable deduction for the failure to pay that amount to you, where you have previously included it as an accruals-based taxpayer in your assessable income. 25-45 is an interesting provision because you can deduct a loss in respect of money if you discover it in a particular income year and the loss was caused by theft, stealing, embezzlement, larceny, defalcation, or misappropriation by your employee or agent, and the money was included in your assessable income. So you're focusing again on accruals-based taxpayers. but you can see how that might impact, for example, a bank. Bank staff steal money, and it might result in an allowable deduction. So it's an interesting and unusual specific circumstance. Parliamentary election expenses are deductible. Local government election expenses are deductible. But the deduction for election expenses does not extend to entertainment. 25-75 is interesting because the state government land tax and the local government rates on premises used to produce mutual receipts are deductions. Another important one is 25-100. Travel between workplaces, not between home and a workplace, but between workplaces, is a deduction. Division 26, which we did touch upon last week, there are some key provisions here. A penalty, so think parking tickets, speeding fines, not deductible. Political contributions and gifts, interest or royalty, quite a specific provision. Maintaining your family, recreational club expenses, non-business boating activities, expenses for a leisure facility, bribes to foreign officials, bribes to public officials, expenditure relating to illegal activities, non-deductible. The next division that's relevant for our purposes is Division 30, gifts or contributions. So if we go to ABN lookup, and we type in search, and we type in Red Cross, Australian Red Cross, and we go down here, and you'll see Australian Red Cross Society is endorsed as a deductible gift recipient from 1 July 2000. It is covered by item 1 of the table in section 30-15 of the 1997 Income Tax Assessment Act. So returning to the provisions, here's Division 30, there's Division 30-15, and there's the table. But what the table is doing is it's identifying the types of entities that will be designated deductible gift recipient entities. And if you go down a little bit further, you'll see environmental organisations, harm prevention, cultural organisations, etc. The different types of entities that will be registered as deductible gift, or will be identified as deductible gift recipients, are referred to there, and you'll see them all sorts of ones referred to there. Think of the art gallery, foundation, etc., etc. That's Division 30. Everything bar the first $2. There's no cap on the amount either. If it's 10 million, you'll still get the full amount of the deduction. Then going further down to Division 40. So here we have capital allowances. Now this is, or these are, depreciation, where you have capital items, and the key provisions are here: diminishing value method and prime cost method. The first thing that you'll notice is that the sorts of depreciation methods that you're used to dealing with in an accounting sense, these are the only two tax depreciation methods. And 40-72, the formulas here for diminishing value post 9 May 2006. It's the base value over the number of days held over 365 times 200% over the asset's effective life. Prime cost method, the formula is also here: assets cost, number of days held over 365, 100% over the asset's effective life. Now, division 40 is a very long division, and you can see it goes right through to section 1130. There are all sorts of provisions about, for example, which of those two methods you should use in particular circumstances. One thing, whichever of the two methods you choose, either in accordance with the legislation or by your choice, you must maintain the same method for the life of the asset. So you can't change methods from year to year. And there's then a process of adjustable value and opening adjustable value of a depreciating asset. It's important that you continue to hold the asset, and the holding of an asset, which is an important concept in terms of Division 40, the holding is not just the legal holding of the asset, but the holding in terms of the use of the asset. So you might legally own something, but you may not continue to hold it in a practical sense if we sort of articulate it like that. And you can see the cost of the asset, whether it includes incidental costs to put an asset into place, are all things dealt with. One thing you'll also notice here is that there is a depreciation that occurs as to motor vehicles, which then is relevant to calculations for all sorts of things, but the depreciation of the motor vehicles. And that car limit that's referred to there, that is often linked with the luxury car tax limit, but the depreciation limit in terms of cars tends to have a linkage, I think, throughout with the luxury car tax limit. So it's about 61,000 around there. So that's Division 40. The next division is Division 43, which is capital works. So here we're talking about fixtures, we're talking about buildings, and there's the ability to claim a deduction for capital works for an income year, which is identified in 43-10. In 43-15, it talks about the amount you can deduct is a portion of your construction expenditure. And if I go back, 43-25, for capital works begun before 27 February 1992, the rate is 4% or 2.5% in any other case. So think about a $400,000 physical building, and then the rate per annum will be 2.4 per financial year will be 2.5% potentially. So they're the key provisions for our purposes. Be aware that there are small business entity provisions which allow you to deduct and pool your assets through a particular calendar year, a financial year, I should say. The pooling provisions and or depreciation, 100% depreciation in specific circumstances. Even in the last couple of weeks, there's been adjustments made in that regard.